All right, if you're a contractor, you know the deal. You've probably wrestled with this exact problem. How in the world do you account for income on a job that's going to take months, maybe even years, to wrap up? Let's get into it. Okay, so picture this. You land a huge project, and a check for $100,000 hits your bank account. Feels pretty amazing, right? But the job itself is going to take 2 full years to finish. So the real question, the one we're here to talk about, is how much of that did you actually make today?
And look, answering that question isn't just some boring exercise for your accountant. How you answer it directly shapes how you see your company's performance, how you plan for taxes, and ultimately it tells the real story of your business's financial health.
So yeah, it's a puzzle. Let's dive in and solve it, shall we? It really all comes down to 2 different ways of looking at the numbers.
There are 2 main, totally accepted methods for tackling this. I want you to think of them less like rigid rules and more like 2 different philosophies for telling your company's financial story as it's actually happening.
First up, we've got the method that gives you a kind of real-time play-by-play of your progress.
It's called the percentage of completion method. And yeah, the name pretty much gives it away, right? You recognize, and that's just accounting talk for officially putting it on the books, your income and your costs in direct proportion to how much of the job is actually done.
Think about it like running a marathon. Instead of just waiting till you cross the finish line to get your final time, you're looking at your watch and reporting your split times at every single mile marker. It's the as-you-go approach, and it gives you this constant stream of data on how you're performing.
So, how does this actually play out with real money? Well, let's say a client pays you $6,000, but you look at your costs and progress, and you know you've only really earned about $4,800 of that so far. That extra $1,200 you're holding on to, that's what accountants call unearned income. You can't count it yet. You have to park it on your balance sheet until you do more work to earn it.
The biggest pro here is accuracy. Your financial statements actually reflect reality, which is absolutely crucial for those big, long projects. You can spot problems early, make changes, and you spread your profit and your tax bill out over time. But, and this is a big but, it all hinges on your estimate of completion. If you get that wrong, the whole picture is off. It really demands that you keep good, consistent records. No winging it.
Okay, so that's philosophy number 1. Now let's check out the second one. Instead of tracking all those mile markers, this method is all about one thing: the finish line. This is the completed contract method. No estimates, no percentages, no partial anything. With this approach, you wait until the job is 100% done, finished, handed over. Only then do you record a single dollar of revenue, cost, or profit.
Let's go back to our marathon. This method is like running the whole race with your eyes closed, ignoring every mile marker. You only report your time once, right after your foot crosses that finish line. It's the all-at-the-end approach. Super simple, but you're basically flying blind until it's all over.
Now the advantages here are pretty obvious. It's exact and it's simple. There's no guesswork. That makes it perfect for small, quick jobs. But for anything long-term, oh man, the disadvantages are huge. You get 0 financial data while the project is going on. It totally distorts your company's performance, and this is a big one, it can create a tax nightmare by dumping all of your profit into a single year.
And you have to know this, it's really important. There are legal limits. Generally speaking, you can only use this method for jobs that are finished within 2 years, and only if your company's annual gross receipts are under $10 million. So it's not for everyone.
So what does this actually look like in the real world? When you put the numbers side by side, the difference is, well, it's crystal clear.
Just look at this. Imagine a 3-year project, total profit of $450,000. Using percentage of completion, your books show a steady, realistic profit of $150,000 each year. Makes sense, right? Now look at the completed contract column. You show 0 profit in year 1, 0 in year 2, and then bam, a massive, totally distorting spike in year 3. Seriously, which story would you rather show your bank? And the source material really hits the nail on the head here. It says, this approach makes your annual comparisons basically useless. That crazy jump in the final year doesn't show steady growth, it just shows how you did your accounting. It completely, totally distorts the real financial picture of your business.
Okay, so we've seen the 2 paths, the 2 completely different philosophies. Now for the most important part, which one should you actually pick?
This is a big decision, you know? It really shapes your entire financial story, and the right answer totally depends on the kind of work you do.
And you know what? The real-world practical answer for a lot of contractors is
You don't have to choose just one. The most common and, frankly, the most sensible approach is often a hybrid. You use the percentage of completion method for your big long-haul contracts, and you use the much simpler completed contract method for all those small, quick jobs. Best of both worlds.
So what are your next steps? It's pretty straightforward. First, just take a look at your jobs and sort them by how long they take. Second, really think about the tax hit. Spreading your profit out evenly is almost always going to be better for you. And third, and this is the most important one, talk to your accountant. Please, this is not a do-it-yourself kind of decision. You need professional advice here.
Because at the end of the day, it all boils down to this. What story do you want your books to tell? Do you want them to tell a simple story about your bank account balance? Or do you want them to tell the true, ongoing story of what your business is actually achieving, what it's earning year after year? That choice, it makes all the difference.